Did you know Wall Street is quietly buying gold and silver right now while everyone else is panicking? A major war just broke out in the Middle East, so normally you would expect a safe asset like gold to skyrocket. But instead, prices are dropping, which might seem really weird to most people. Today, we are going to look at the simple economic reasons behind this, and why this drop is actually a massive, historic opportunity. First, let's look at the broader economy and inflation. The recent conflict has sent oil prices flying past $110 a barrel. When oil gets expensive, it drives up inflation, making everyday costs soar, just like a simple loaf of bread suddenly costing $10 at the bakery. Because of this high inflation, the Federal Reserve has to keep interest rates high. High interest rates make cash sitting in the bank look much more attractive than gold, which pays zero interest. This extreme economic pressure is completely shifting the foundation of the country. People are fleeing expensive coastal areas because of crushing insurance costs and moving to affordability havens in the Midwest, where homes are much cheaper. At the same time, we are seeing a massive nearshoring boom, filling up border warehouses as supply chains are forced to move closer to home. So why did gold crash down to $4,500 an ounce right after the war started? It is a phenomenon experts call the Pettenkoppel effect. Think of a massive supermarket sale. If everyone knows about it days in advance, they line up early, and by the time the sale officially starts, the store is actually empty. The exact same thing happens with war. People bought gold out of fear before the conflict, so the price drop is just the fear already being priced in. When a crisis hits, global money flocks to the dollar, making it stronger. It is like having a popular dollar store offering 7% interest right next to a gold store that pays 0%. But here is the real secret. The market right now is split into two floors. On the top floor, regular retail investors are panicking and selling their gold. In fact, J.P. Morgan estimates that central banks will sweep up 755 tons of gold this year alone, when the U.S. froze $300 billion in Russian reserves. Other countries learned that dollars can be frozen with the push of a button, but physical gold inside a vault is yours forever, creating a permanent engine pushing gold higher. Now, let's talk about silver, which is literally the rice of modern industry. Silver is absolutely essential for solar panels, EV batteries, AI chips, and 5G networks. Industrial demand is growing so fast that it has exceeded the available supply for 5 years in a row. Because of this massive shortage, silver is now officially recognized as a critical strategic resource, just like rare earth metals. Even better, silver is severely undervalued right now, sitting at a 6.4x price ratio compared to gold. Historically, silver acts like it has powerful leverage attached to it. If gold goes up 1%, silver might jump 2% or 3%. Last year alone, while gold went up 65%, silver skyrocketed 150%, making it the ultimate high-reward opportunity. The ultimate lesson here is to ignore the short-term noise. Do not let temporary price drops or scary news headlines shake you out of your position. The massive structural changes like central banks escaping the dollar and AI devouring silver are permanent. Focus on the big picture, because the people who understand these underlying shifts are the ones who win. As we look ahead, there are three main scenarios. If inflation stays high, we might see a short-term drop in prices. But central bank buying will protect the bottom like concrete. If the conflict worsens and oil spikes further, gold and silver will absolutely explode past their targets. And even if a peace treaty is signed tomorrow causing a quick dip, the long-term trend pushing gold and silver higher will not change at all. So if the long-term case for gold is still intact, what should regular investors actually do? Keep it simple. Buy a low-cost gold ETF. It is the easiest, cleanest, and most efficient way to get gold exposure in a normal brokerage account. Vaulted gold adds extra fees. Mining stocks add company risk. And physical gold bars come with markups, storage headaches, and tax costs that can quietly crush your returns. If you want to act on this opportunity the smart way, don't overcomplicate it by the ETF. Finally, always be aware of the risks. Because gold and silver jumped so much last year, people will take profits and cause sudden price swings. Sudden peace talks or extended high interest rates can also slow things down. But investing is a battle between getting distracted by the daily noise and seeing the true, massive shift happening underneath. Keep your eyes on the prize, and subscribe to Economic Hunter so we can all get rich together.